Welcome back to Synaptic Dividends. We break down a new dividend stock every single week to help you build out that passive income portfolio. So if that's your goal, you're going to want to make sure you're subscribed so you don't miss a thing.
All right, so today we're putting the global insurance giant Chubb right under the microscope. Now, this company is famous for its dividend, but the big question we've got to ask is this: is a 32-year streak of dividend growth really as unbreakable as it sounds? Or, is it maybe running out of steam? Let's dig into the numbers and find out.
Okay, first up in our investigation, the cash flow cushion. And you can really think of this as the ultimate lie detector test for figuring out how safe a dividend actually is.
So what we're looking at here is the free cash flow payout ratio. And what does that mean? Well, in simple terms, it tells us exactly what percentage of a company's real, cold, hard cash profit is being used to pay out those dividends to shareholders. And listen, this is way more important than just looking at accounting profits, because at the end of the day, dividends get paid with cash, not some number on a spreadsheet.
So what's the big number here? Get this, just 9.4% over the last 12 months. Just let that sink in for a second. For every single dollar of real cash that this business brought in, less than a dime went back out the door to pay the dividend. That is an absolutely massive safety cushion. Huge.
And this right here, this is exactly why we say cash flow is king. If you look back at 2020, with all that market chaos, the payout ratio based on net income, the accounting profit, it jumped to nearly 40%. But look at the cash flow payout ratio. It stayed at a super healthy 14.3%. This just perfectly shows that even when the accounting numbers were getting all shaky, the underlying cash machine was just humming along, easily covering that dividend.
Okay, so that strong cash flow is one thing. That's huge. But what about consistency? Can they keep it up? Let's take a look at the company's incredible history of rewarding its shareholders.
32. Chubb has increased its dividend for 32 consecutive years. That's a long time. It puts them in a very elite club of companies. Look, a track record like this doesn't just happen by accident. It's the result of a deliberate, long-term commitment to paying back its shareholders.
And this growth, it hasn't just been for show either. Over the last 10 years, the dividend has grown at an average annual rate of 5.37%. What this tells us is that there's a pattern here, a pattern of steady, predictable, meaningful growth that really compounds your income over time. And as a long-term investor, that is exactly what you want to see.
All right, so we've established the dividend is well covered by cash and it's got a long history of growth. But what about the ultimate trial by fire? How does it hold up when things get really tough? Let's see how this dividend performed during some major economic crises.
Okay, this is just amazing. Let's look at the global financial crisis of 2008. This was a time when other financial giants were literally collapsing. And Chubb, they didn't just survive. They didn't just maintain their dividend. No way. They actually increased it from $1.06 per share in 2007 to $1.09 right in the middle of the storm in 2008. Now that is a powerful statement. And guess what? They did it again. Fast forward to the COVID-19 pandemic, that unprecedented global shutdown, another time of extreme economic stress, and the pattern just repeated itself. The dividend just kept on climbing, didn't miss a single beat. This really proves the resilience of their business model when the going gets tough.
So, we've looked at the cash flow, we've reviewed the history, and we've checked its crisis performance. I think it's time. Let's weigh all the evidence and deliver our final verdict on the safety of Chubb's dividend.
Okay, so let's just lay out the evidence file one more time. First, you've got that massive cash cushion with a payout ratio under 10%. Check. Second, you have a 30-year track record of unbroken dividend growth. Check. And third, we have proven undeniable resilience through two of the absolute worst economic crises in modern history. Check.
When you put it all together, the evidence is crystal clear. Chubb's dividend isn't just safe, it's a fortress. It's a fortress built on a foundation of massive cash flow, a really disciplined history, and a business model that has truly been battle-tested.
Now, if you want to go deeper and really understand the full business model behind all these numbers, you should check out our long-form analysis over on our main channel, Synaptic Investing. And of course, if you found this breakdown helpful, a like is always appreciated. And be sure to subscribe for more dividend analyses just like this one. Thanks for watching.